Compound interest will make me rich for this simple reason. Imagine I give you two options, $1 million today or a penny that doubles in value every day for a month. Which one would you choose? Most people would grab the $1 million, but let's break it down. That penny, that doubles daily, reaches over $5.4 million by day 30. This incredible growth happens mostly in the latter half of the month. It's because compounding is slow at the beginning but skyrockets over time. And in investing, that's the same thing. The magic happens in the long run. If you have a good strategy and you are patient, you cannot help but become rich. You now understand the sentences like money makes money or the rich are getting richer. That's exactly what we're talking about today. Don't forget to hit the like button and let's start. Compound interest is the interest on a deposit calculated based on both the initial principal and accumulated interest from previous periods. For example, if you have $1,000 and you earn 10% per year, after the first year, you will get $1,100. You get the initial $1,000 plus $100 of interest, okay? In the second year, you earn 10% on $1,100, resulting in $1,210. This process continues with interest being calculated on the new balance each year. And if you continue like this, the growth is exponential. That's why Albert Einstein famously referred to compound interest as the eighth wonder of the world. And the sooner you understand this concept, the richer you will be. The prime example of compounding is Warren Buffett. He started investing in the stock market when he was 11 years old. Because he started young and he had a great performance, he managed to be a millionaire in his 30s and a billionaire at 56. That's a fantastic growth. But what is even better is that 99% of his current wealth was created after he turned 50. The power of compounding is truly beautiful. Those who use compound interest have understood something. They have understood that the first years are very slow and then everything goes fast. In general, net worth tends to accelerate once you reach $100,000. It's not just because of better investment opportunities, but also the scale of capital and compound interest. Because it's not the same if you make 10% per year with $1,000 and 10% per year with $100,000. The numbers are totally different. Larger investments lead to higher absolute returns, which accelerates wealth growth. There is no doubt that the hardest part is reaching the first $100,000. Once achieved, growth accelerates as money works on itself, similar to a snowball effect. Money makes more money. And if you liked the Warren Buffett example, here is what his business partner, Charlie Munger, had to say about compounding. The first rule of compounding is to never interrupt it unnecessarily. Maybe you will not see the effect of compounding in the short term, but you have to trust the process. Let's illustrate this with an example. You have two investors, John and Lisa. Both invest $1,000 at an annual rate of 10%. John spends the interest earned each year, maintaining his principal at $1,000. Lisa reinvests the interest, allowing her investment to compound over 30 years. What is the difference after 30 years? Well, let's see. For John, each year, John earns $100 in interest. That's 10% of $1,000. He withdraws the $100 interest annually, leaving his principal untouched. After 30 years, he has withdrawn $3,000 in total interest. That's $100 times 30 years. His final account balance remains $1,000. That's the initial principal. And John's total earnings amount to $4,000. That's $3,000 in interest and $1,000 in principal. For Lisa reinvests her interest earnings each year. After the first year, she has $1,100. That's the initial 1,000 and you get $100 of interest. In the second year, she earns 10% of $1,100, resulting in $1,210. This process continues with interest being calculated on the new balance each year. After 30 years, Lisa's total earnings amount to more than $17,000. Her total earnings are over 4 times more than John's due to compound interest. So the difference is significant between simple interest for John and compound interest for Lisa. By reinvesting earnings, Lisa's investment benefits from exponential growth. And if instead of 30 years it was 50 years, the difference would have been even greater. Now, if you have a specific number that you want to reach for your retirement, there is a simple formula to estimate how long it takes for an investment to double. It's called the rule of 72. You just have to divide 72 by your annual growth rate. For example, if your investments grow at 10% annually, they will double in about 7.2 years. If your investments grow at 14% annually, they will double in about 5.1 years. This rule shows how even small differences in growth rates matter. Over 30 years, an investment growing at 10% per year can quadruple your money 4 times, turning $100,000 into $1.7 million. In contrast, at 14% per year, you reach $5.1 million. A small 4% change had an impact of $3 million. Now that you understand this, you will pay more attention to your banking fees. By the way, we talked about a 14% annual return, but if you do better, you will get even better returns. Over the past 7 years, I've achieved a performance of 24% annual returns in the stock market. So if I put 24% in my compounding table, over 30 years, it makes you dream with $63 million. It's unlikely that I continue to do 24% in the future. Maybe I will not do 20%, but my job is to do better than 14%. And having these kind of returns will have a huge impact on my long-term wealth. If you want to know the simple method I use to generate strong returns, click the first link in the description. There is a free masterclass where I will give you great investing tips. So, you've learned that compounding is magical, especially when your wealth grows at a good rate. And it's important to start early. But don't worry, it's never too late to start investing. Even starting at 30, 40, or 50 can yield significant results due to compound growth. As we say, the best time to start was 20 years ago, but the second best time is today. And if you want to take advantage of compounding, here are 3 tips that will make you more money. First, invest regularly in the stock market using dollar cost averaging. It means you invest money in the stock market every year, every month, regardless of whether the stock market goes up or down. If you invest like this, with this simple process, you will take advantage of volatility and buy when it's cheap. You will have a decent performance. Second, focus on increasing monthly contributions. For example, investing $2,000 monthly for 30 years at 10% yields $4.3 million. Doubling the contribution to $4,000 monthly achieves about $8.6 million. $2,000 per month doesn't sound like a lot, but after 30 years, the amount is significant. The third tip is about taxes and is extremely important. Imagine you have $1 doubling 20 times. If you let the money compound in a tax-free account, it will grow to $1 million. But if you have to pay a 25% tax on your gains each year, the final amount is reduced to only $70,000. What you want is tax-free growth, and you can use tax-advantaged accounts like a Roth IRA to significantly reduce your tax burden. And that's it. Start investing early and let your money compound at a high rate of return. Click the first link in the description. There is a free masterclass where I will teach you how I achieved 24% annual returns investing in stocks. Just click on the link and you will receive the free masterclass. So I'm going to leave the next video up there, but don't just click on it yet. Make sure to leave a like and subscribe for more videos like this. Okay, see you over there.